Day 30 of the series. We will be starting with chapter 4, mutual funds and other investment companies. So let's begin. The previous chapter introduced you to the mechanics of trading securities and the structure of the markets in which securities trade. Commonly, however, individual investors do not trade securities directly for their own accounts. Instead, they direct their funds to investment companies that purchase the securities on their behalf. The most important of these financial intermediaries are open-end investment companies, more commonly known as mutual funds, to which we devote most of this chapter. We also touch briefly on other types of investment companies, such as unit investment trust, hedge funds, and closed-end funds. We begin the chapter by describing and comparing the various types of investment companies available to investors. We then examine the functions of mutual funds, their investment styles and policies, and the costs of investing in these funds. Next, we take a first look at the investment performance of these funds. We consider the impact of expenses and turnover on net performance and examine the extent on which performance is consistent from one period to the next. In other words, will the mutual funds that were the best past performers be the best future performers? Finally, we discuss the sources of information on mutual funds. Then we consider in detail the information provided in Morningstar's mutual fund reports. 4.1 Investment companies. Investment companies are financial intermediaries that collect funds from individual investors and invest those funds in a potentially wide range of securities or other assets. Pooling of assets is the key idea behind investment companies. Each investor has a claim to the portfolio established by the investment company in proportion to the amount invested. These companies thus provide a mechanism for small investors to team up and obtain the benefits of large-scale investing. Investment companies perform several important functions for their investors. 1. Record keeping and administration. Investment companies issue periodic status reports keeping track of capital gains, distribution, dividends, investments, and redemption. They may reinvest dividend and interest income for shareholders. 2. Diversification and divisibility. By pooling their money, investment companies enable investors to hold fractional shares of many different securities. They can act as large investors even if any individual shareholder cannot. 3rd, professional management. Investment companies can support full-time staffs of security analysts and portfolio managers who attempt to achieve superior investment results for their investors. Lower transaction costs. Because they trade large blocks of securities, investment companies can achieve substantial savings on brokerage fees and commissions. While all investment companies pool assets of individual investors, they also need to divide claims to those assets among these investors. Investors buy shares in investment companies, and ownership is proportional to the number of shares purchased. The value of each share is called the net asset value, NAV. Net asset value equals assets minus liabilities expressed on a per share basis. Net asset value equals to market value of assets minus liabilities divided by share outstanding. Example 4.1, net asset value. Consider a mutual fund that manages a portfolio of securities worth $120 million. Suppose the fund owes $4 million to its investment advisors and another $1 million for rent, wages due, miscellaneous expenses. The fund has 5 million shares outstanding. Net asset value will be 120 million minus $5 million divided by 5 million shares, which is $23 per share. Concept check 4.1. Consider these data from the March 2016 balance sheet of Vanguard's Growth and Income Fund. What was the net asset value of the fund? Assets 5986 million, liabilities 118.5 million, shares 148.36 million. So the net asset value, NAV, will be equal to assets 5986 minus liabilities 118.5 divided by 148.36. So let's quickly do that calculation. 5 986 minus 118.5 divided by 148.36. 39.549. Dollars per share. Okay. So yeah, 4.2 types of investment companies. In the United States, investment companies are classified by the Investment Company Act of 1940 as either unit investment trusts or managed investment companies. The portfolios of unit investment trusts are essentially fixed and thus are called unmanaged. In contrast, managed companies, so named because securities in their investment portfolios are continually bought and sold. Portfolios are managed. Managed companies are further classified as either closed end or open end. Open end companies are what we commonly call mutual funds. Unit investment trusts. Unit investment trusts are pools of money invested in a portfolio that is fixed for life of the fund. To form a unit investment trust, a sponsor, typically a brokerage firm, buys a portfolio of securities that are deposited into a trust. It then sells shares or units in the trust called redeemable trust certificates or income. All income and payments of principal from the portfolio are paid out by the fund's trustees, a bank, or trust company to the shareholders. There's little active management of a unit investment trust because once established, the portfolio composition is fixed. Hence, these trusts are referred to as unmanaged. Trusts tend to invest in relatively uniform types of assets. For example, one trust may invest in municipal bonds, another in corporate bonds. The uniformity of the portfolio is consistent with a lack of active management. The trust provides investors a vehicle to purchase a pool of one particular type of asset that can be included in an overall portfolio as desired. Sponsors of unit investment trusts earn their profit by selling shares in the trust at a premium to the cost of acquiring the underlying assets. For example, a trust that has purchased $5 million of assets may sell 5,000 shares to the public at the price of 1030 per share, which, assuming the trust has no liabilities, represents 3% premium over the net asset value of the securities held by the trust. The 3% premium is the trustee's fee for establishing the trust. Investors who wish to liquidate their holdings of a unit investment trust may sell the shares to the trustee for the net asset value. The trustees can either sell enough securities from the asset portfolios to obtain the cash necessary to pay the investor, or they may instead sell the shares to new investor, again at a slight premium to net asset value. Unit investment trusts have steadily lost market share to mutual funds in recent years. Assets in such trusts declined from $105 billion in 1990 to only $94 billion in 2016. Managed investment companies. There are two types of managed investment companies: closed end and open end. In both cases, the fund's board of directors, which is elected by shareholders, hires a management company to manage the portfolio for an annual fee that typically ranges from 0.2% to 1.25% of all assets. In many cases, the management company is the firm that organizes the fund. For example, Fidelity Management and Research Corporation sponsors many Fidelity mutual funds and is responsible for managing the portfolios. It assesses a management fee on each Fidelity fund. In other cases, a mutual fund will hire an outside portfolio manager. For example, Vanguard has hired Wellington Management as the investment advisor for its Wellington fund. Most management companies have contracts to manage several funds. Open-end funds stand ready to redeem or issue shares at the net asset value. Although both purchases and redemptions may involve sales charges, When investors in open-end funds wish to cash out their shares, they sell them back to the fund at net asset value. Um, Open-end funds stand ready to redeem or issue shares at the net asset value, although both purchases and redemption will on a state charge. When investors in open-end funds wish to cash out their shares, they sell them back to the fund at the net asset value. In contrast, closed-end funds do not redeem or issue shares. It's issue shares. A bit of a tongue twister there. Sorry. Investors in closed-end funds who wish to cash out must sell their shares to other investors. Shares of closed-end funds are traded on organized exchanges and can be purchased through brokers just like other common stock. Their prices therefore can differ from the net asset value. In early 2016, about $261 billion of assets were held in closed-end funds. Figure 4.1 is a listing of closed-end funds. The first column gives us the name and ticker symbol of the fund. Next two columns gives us the fund's most recent net asset value and closed share price. Premium or discount in the next column is a percentage difference from between price and NAV, price minus NAV divided by NAV. Notice that these funds are selling at discounts to NAV indicated by negative differences. Find the 52-week return based on the percentage change in the share price plus dividend income is presented in the last column. So as you can see in figure 4.1, closed and mutual funds, we have the net asset value, we have the market price, we have the premium or discount percentage, which is price minus NAV by NAV. Okay, sure. Okay, the common divergence of price from net asset value, often by wide margins, is a puzzle that has yet to be fully explained. To see why this is a puzzle, consider a closed-end fund that is selling at a discount from net asset value. If the fund were to sell all the assets in the portfolio, it would realize proceeds equal to the net asset value. The difference between the market price of the fund and the fund's NAV would represent the per share increase in the wealth of the firm's investors. Moreover, fund premiums or discounts tend to dissipate over time. So, funds selling at a discount receive a boost to their rate of return as the discount shrinks. Pontiff estimates that a fund selling at 20% discount would have an expected 12-month return more than 6% greater than funds selling at net asset value. Increasingly, while many closed-end funds sell at a discount from net asset value, the prices of these funds, when originally issued, are often above net asset value. This is a further puzzle as it is hard to explain why investors would purchase these newly issued funds at a premium to NAV when the shares tend to fall to a discount shortly after issue. In contrast to closed-end funds, the price of open-end funds cannot fall below NAV because these funds stand ready to redeem shares at NAV. The offering price will exceed NAV. However, if the fund carries a load is in fact a sales charge. Load funds are sold by securities brokers and directly by mutual fund groups. Unlike closed-end funds, open-end mutual funds do not trade on organized exchanges. Instead, investors simply buy shares from and liquidate through the investment company at net asset value. Thus, the number of outstanding shares of these funds changes daily. Other investment organizations, some intermediaries are not formally organized or regulated as investment companies but nevertheless serve similar functions. Three or more important are commingled funds, real estate investment trusts, and the really super attractive and interesting one, which is the hedge funds. So obviously we all know hedge funds are the main thing. I'm very obsessed with Billions right now, and I'm watching it for the third time, I guess. Watching Bobby Axelrod, around the same time last year, exactly a year ago. Also, I was into Billions, and I was just starting to get into it. and I finished it within maybe 10 days, maybe 2 weeks. But yeah, like I'm really into the hedge fund space right now. Doesn't mean that I don't even know what it means, but I'm just into that vibe right now, to be honest. Anyways, continuing. Commingled funds. Commingled funds are partnerships of investors that pool funds. The management firm that organizes the partnership, for example, a bank or insurance company, manages the funds for a fee. Typical partners in a commingled fund might be trust or retirement accounts with portfolios much larger than those of most individual investors, but still too small to warrant managing on separate basis. Commingled funds are similar in form to open-end mutual funds. Instead of shares, though, the fund offers units which are bought and sold at net asset value. A bank or insurance company may offer an array of different commingled funds, for example, a money market fund, bond fund, common stock fund. Real estate investment trusts, REITs. A REIT is similar to a closed-end fund. REITs invest in real estate or loans secured by real estate. Besides issuing shares, they raise capital by borrowing from banks and issuing bonds or mortgages. Most of them are highly leveraged with a typical debt ratio of 70%, which is super leveraged. Though there are two principal kinds of REITs. Equity trusts invest in real estate directly, whereas mortgage trusts invest primarily in mortgage and construction loans. REITs generally are established by banks, insurance companies, or mortgage companies, which then serve as investment managers to earn a fee. Hedge funds. Like mutual funds, hedge funds are vehicles that allow private investors to pool assets to be invested by a fund manager. Unlike mutual funds, however, hedge funds are commonly structured as private partnerships and thus subject to only minimal SEC regulation. They typically are open to wealthy or institutional investors. Many require investors to agree to initial lockups, that is, periods as long as several years in which investments cannot be withdrawn. Lockups allow hedge funds to invest in illiquid assets without worrying about meeting demands for redemption of funds. Moreover, because hedge funds are only lightly regulated, their managers can pursue investment strategies involving, for example, heavy use of derivatives, short sales, and leverage. Such strategies typically are not open to mutual fund managers. Hedge funds, by design, are empowered to invest in a wide range of investments, with various fund focusing on derivatives, distressed firms, currency speculation, and convertible bonds, emerging markets, arbitrage, uh, arbitrage, and so on. Other funds may jump on from one asset class to another as perceived investment opportunities shift. Hedge funds enjoyed great growth in the last several years with assets under management ballooning from about $50 billion in 1990 to about $3 trillion in 2016. We devote all of chapter 26 to these funds. So that would be an interesting chapter. Next, we move on to mutual funds, which is the main part of the chapter. Mutual funds are the common name for open-end investment companies. This is the dominant investment company today, accounting for 87% of investment company assets. Assets under management in the US mutual fund industry were approximately $15.7 trillion in early 2016, with approximately the same announcement held in non-US funds. Investment policies. One second. Yeah. Investment policies. Each mutual fund has a specified investment policy, which is described in the fund's prospectus. For example, money market mutual funds hold the short term, low risk instruments of the money market sector. See Chapter 2 for a review of these securities. While bond funds hold fixed income securities, some funds have even more narrowly defined mandates. For example, some bond funds will hold primarily treasury bonds and other primary mortgage backed securities. Management companies manage a family or complex of mutual funds. They organize an entire collection of funds that then collect a management fee for operating them. By managing a collection of funds under one umbrella, these companies make it easy for investors to allocate assets across market sectors and to switch assets across funds while still benefiting from centralized record keeping. Some of the most well known management companies are Fidelity, Vanguard, Barclays, and T. Rowe Price. Each offers an array of open end mutual funds with different investment policies. In 2016, there were about 8,000 mutual funds in the US, which were offered by more than 800 fund complexes. Funds are commonly classified by investment policy into one of the following groups: money market funds, equity funds, sector funds, bond funds, international funds, balance funds, asset allocation, and flexible funds and index funds. Market Money market funds. These funds invest in money market securities such as commercial paper, repurchase agreements, or certificates of deposit. The average maturity of these assets tend to be a bit more than 1 month. Money market funds usually offer check writing features and net asset value is fixed at $1 per share. So there are no tax implications such as capital gains or losses associated with redemption of shares. Equity funds. Equity funds invest primarily in stock, although they may, at the portfolio manager's discretion, also hold fixed income or other types of securities. Equity funds commonly will hold between 4 and 5% of total assets in money market securities to provide the liquidity necessary to meet potential redemption of shares. Stock funds are traditionally classified by their emphasis on capital appreciation versus current income. Thus, income funds tend to hold shares of firms with consistently higher dividend yields. Growth funds are willing to forego current income, focusing instead on prospects for capital gains. While the classification of these funds is couched in terms of income versus capital gains, in practice, the more relevant distinction concerns the level of risk these funds assume. Growth stocks and therefore growth funds typically riskier and respond more dramatically to changes in economic conditions than do income funds. Sector funds. Some equity funds, called sector funds, concentrate on a particular industry. For example, Fidelity markets dozens of select funds, each of which invests in a specific industry such as biotechnology, utilities, energy, or telecommunications. Other funds specialize in securities in particular countries. Bond funds. As the name suggests, these funds specialize in fixed income sector. Within that sector, however, there's a considerable room for further specialization. For example, various funds will concentrate on corporate bonds, treasury bonds, mortgage-backed securities, or municipal tax-free bonds. Indeed, some municipal bonds bond funds, invest only in bonds of a particular state or even city to satisfy the investment desires of residents of that state who wish to avoid local as well as federal taxes on interest income. Many funds also specialize by maturity, ranging from short term to intermediate to long term, or by the credit risk of the issuer, ranging from very safe to high yield or junk bonds. International funds. Many funds have an international focus. Global funds invest in securities worldwide, including the United States. In contrast, international funds invest in securities of firms located outside the United States. Regional funds concentrate on a particular part of the world, and emerging market funds invest in companies of developing nations. Balanced funds. Some funds are designed to be candidates for an individual's entire investment portfolio. These balanced funds hold both equities and fixed income securities in relatively stable proportions. Life cycle funds are balanced funds in which the asset mix can range from aggressive primary market to younger investors to conservative directed older investors. Static allocation life cycle funds maintain a stable mix across stocks and bonds, while targeted maturity funds gradually become more conservative as the investor ages. Many balanced funds are, in fact, funds of funds. These are mutual funds that primarily invest in shares of other mutual funds. Balanced funds are funds invest in equity and bond funds in proportions suited to the investment goals. This is getting crazy. It's like the CDO, a mortgage-backed security in a mortgage-backed security in a mortgage-backed security, bundled up over and over and over and over. A CDO squared, which is known as a synthetic CDO. So it's it reminds me of that scene from The Big Short. But anyways, moving on, asset allocation and flexible funds. These funds are similar to the balanced funds in which they hold both stocks and bonds. However, asset allocation funds may dramatically vary the proportions allocated to each market in accord with the portfolio manager's forecast of the relative performance of each sector. Hence, these funds are engaged in market timing and are not designed to be low risk investment vehicles. Index funds. An index fund tries to match the performance of a broad market index. The fund buys shares and securities included in a particular index in proportion to each security's representation in that index. For example, the Vanguard 500 index is a mutual fund that replicates the composition of the Standard & Poor's 500 stock price index. Because the S&P 500 is a value weighted index, the fund buys shares in each S&P 500 company in proportion to the market value of that company's outstanding equity. Investment in an index fund is low cost way for small investors to pursue a passive investment strategy, that is to invest without engaging in security analysis. More than 20% of equity funds in 2016 were indexed. Of course, index fund can be tied to non-equity indexes as well. For example, Vanguard offers a bond index fund and real estate index fund. Table 4.1 breaks down number of mutual funds by investment rotation. Sometimes a fund named describes its investment policy. For example, Vanguard's GNMA fund invests in mortgage-backed securities. The Municipal Intermediate Fund invests in intermediate form municipal bonds, and the High Yield Corporate Bond invests in large part speculative grade or junk bonds with high yields. However, names of common stock funds often reflect little or nothing about their investment policies. Examples are Vanguard's Winston and Wellington funds. How funds are sold. Mutual funds are generally marketed to the public either directly by the fund underwriter or indirectly through brokers acting on behalf of the underwriter. Directly marketed funds are sold through the mail, various offices of the fund, over the phone, more so over the internet. Investors contact the fund directly to purchase shares. About how the fund sales today are distributed through a sales force. Brokers or financial advisors receive a commission for selling these to investors. Ha! That's what my dad does. I'll send him a picture of this later. Ultimately, the commission is paid by the investor. More on this shortly. Investors who rely on their broker's advice to select their mutual funds should be aware that this advice may suffer from a conflict of interest if the broker receives compensation for directing the sale to a particular fund. Table 4.1. As we can see, the equity funds, bond funds, hybrid money market funds. So a lot of funds, probably around around like 15,000 funds. That's a lot of funds. 15,000 funds. But yeah, I mean, this is worldwide, so 15,000 funds sounds fine. Many funds are also sold through financial supermarkets that sell shares in funds of many complexes. Instead of charging customers a sales commission, the broker splits management fees with the mutual fund company. Another advantage is unified um, record keeping for all funds purchased from the supermarket, even if the funds are offered by different complexes. On the other hand, many contend that these supermarkets result in higher expense ratios because mutual funds pass along the costs of participating in these programs in form of higher management fees. Costs of investing in mutual funds, fee structure. An individual investor choosing a mutual fund should consider not only the fund's stated investment policy and past performance, but also its management fees and other expenses. Comparative data on Comparative data on virtually all important aspects of mutual funds are available on Morningstar's website at www.morningstar.com. You should be aware of four general classes of fees. Operating expenses are the costs incurred by the mutual funds operating the portfolio, including administrative expenses, advisory fees paid to the investment manager. These expenses, usually expressed as a percentage of total assets under management, may range from 0.2% to 2%. Shareholders not receive an explicit bill for these operating expenses. However, the expenses periodically are deducted from the assets of the fund. Shareholders pay for these expenses through the reduced value of the portfolio. The simple average of the expense ratio of all equity funds in the US was 1.31% in 2015. But larger funds tend to have lower expense ratios, so the average expense ratio weighted by assets under management is considerably smaller, 0.68%. Not surprisingly, the average expense ratio of actively managed funds is considerably higher than that of index funds, 0.84% versus 0.11%, weighted by assets under management. In addition to operating expenses, many funds assess fees to pay for marketing and distribution costs. These charges are used primarily to pay the brokers or financial advisors who sell the funds to the public. Fees to pay for marketing and distribution costs. Uh, Sell the funds to the public. Investors can avoid these expenses by buying shares directly from the fund sponsor. Many investors are willing to incur these distribution fees in return for the advice they may receive from their broker or financial advisor. Lamo. Anyways, front end load. A front end load is a commission or sales charge paid when you purchase the shares. These charges, which are used primarily to pay the brokers who sell the funds, may not exceed 8.5%, but in practice, they are rarely higher than 6%. Low load funds have loads that range up to 3% of invested funds. No load funds have no front end sales charges. Loads effectively reduce the amount of money invested. For example, each $1,000 paid for a fund with 6% load results in sales charge $60 and fund investment of only $940. You need cumulative returns of 6.4% of your net investment. 60 by 940 is 0.6.4 just to break even. Back-end load. Back-end load is a redemption or exit fee incurred when you sell your shares. Typically, funds that impose back-end load start them at 5% or 6%, reduce them by 1 percentage point for every year the funds are left invested. Thus, an exit fee that starts at 6% would fall to 4% by the start of your third year. These charges are known more formally as contingent deferred sales loads. 12B1 charges. The Securities and Exchange Commission allows the managers of so called 12B1 funds to use funds assets to pay for distribution costs such as advertising, promotional literature, including annual reports and prospectuses, and most important, commissions paid to brokers who sell the funds to investors. These 12B1 fees, named after the SEC rule that permits use of the plans, funds may use 12B1 charges instead of additional front loads to generate the fees with which to pay the brokers. As with operating expenses, investors are not billed for 12b1 charges. Instead, the fees are deducted from the assets of the fund. Therefore, 12b1 fees, if any, must be added to operating expenses to obtain the true annual expense ratio of the fund. The SEC requires that all funds include in the prospectus a consolidated expense table that summarizes relevant fees. 12b1 fees are limited to 1% of a fund's average net assets per year. Many funds offer classes that represent ownership in the same portfolio of securities but with different combinations of fees. Typically, Class A shares have front end loads and small 12b1 fee, often around 0.25%. Class C shares rely on large 12b1 fees, commonly 1%, often charge a modest back end load. Class 1 shares are sold to institutional investors. These are sometimes called Class Y shares and carry no loads or 12b1 fees. Each investor must choose the best combination of fees, obviously pure, no load, no fee funds distributed directly by the mutual fund group, the cheapest alternative. These will often make the most sense for knowledgeable investors. However, as we have noted, many investors are willing to pay for financial advice, and the commission paid to advisors who sell these funds are the most common form of payment. Alternatively, investors may choose to hire a free, fee only financial manager who charges directly for services instead of collecting commissions. These advisors can help investors select portfolios with low or no load invest funds, as well as provide other financial advice. Independent financial planners have become increasingly important distribution channels for funds in recent years. If you do buy a fund through a broker, the choice between paying a load and paying 12b1 fees will depend primarily on your expected time horizon. Loads are paid only once for each purchase, whereas 12b1 fees are paid annually. Thus, if you plan to hold your fund for a long time, a one time load may be preferable to recurring 12b1 charges. Fees and mutual fund returns. The rate of return on an investment in mutual fund is measured as the increase or decrease in net asset value plus income distributions such as dividends or distributions of capital gains expressed as a fraction of net asset value, the beginning of the investment period. If we denote the net asset value, the start and the end of the period as NAV 0 and NAV 1 respectively, then rate of return will be NAV 1 minus NAV 0 plus income and capital gain distribution divided by NAV 0. Hmm. Yeah, you know what? I'm gonna take a 5-minute break and then continue. So, yeah, thanks.